What is up, guys, and welcome to another edition of the Market Marauder Show. Reading the market one trade at a time. Hope everybody's having a great week out there, able to lock in some profits. In this episode, we're going to be talking about some financial recession prep. So, you may have seen in the headlines in the news that we may be heading into a recession. Some investors say we already are in a recession. But I want to outline some key things that I think everybody should do to just prepare themselves and their families financially, some investing strategies, as well as just things that I know that I'm doing financially to try to prepare for the potential recession. First up, let's shout out to the sponsor, Duck River Coffee. Make sure you go grab a bag of Duck River Coffee today. Website down below. All right, so let's jump into the first thing. I think the first thing everybody should have is a budget. So before you start investing in anything, I think you should have an emergency fund of whatever you think is a decent amount of money. This is not financial advice. I know this is very Dave Ramsey-esque to say, hey, you need a budget. This is kind of not the same advice as that. This is just basically saying you need a budget for any type of expenses that are coming up in the potential future, whether the price of milk or something fluctuates, or car maintenance or things of that nature that comes up. I think a budget is a great way to see where the money is coming in and where the money is going out, and kind of assess your financial future that way. Next, I want to talk about REITs. REITs is a way that you can invest into stocks that is similar to real estate, but it pays you a monthly dividend. So REITs are pretty cool. There are some out there. One of the most popular ones is Realty, which I'll talk about a little later on. But let's talk about REITs for those who don't know. So REITs, being REIT, stands for Real Estate Investment Trust. Real Estate Investment Trust is a company that owns, operates, or finances income-generating real estate. Modeled after funds, REITs pull the capital of numerous investors. This makes it possible for individual investors to earn dividends from real estate investments without having to buy, manage, or finance any properties themselves. So you basically are getting into real estate without having to foot the bill for, a water heater went out or an HVAC unit went out, or something happened with tenants, but you still get a way to get into real estate this way, and you reap the benefits of real estate. So how a REIT works, Congress established REITs in 1960 as an amended to the cigar excise tax extension. The provision allows investors to buy shares in commercial real estate portfolios, something that was previously available only to wealthy individuals and through large financial intermediaries. Properties in a REIT portfolio may include apartment complexes, data centers, healthcare facilities, hotels, infrastructure in the form of fiber cables, cell towers, and energy pipelines, office buildings, retail centers, self-storage, timberland, and warehouses. In general, REITs specialize in a specific real estate sector. However, diversified and specialty REITs may hold different types of properties in their portfolios, such as REITs that consider or consist of both office and retail properties. So that's kind of just REITs in a nutshell. You can get paid from having a REIT, and usually most of them pay out monthly. And so it's a great way to diversify your portfolio by adding immediate cash flow to your portfolio. So cash flow being, since they pay out a dividend every month or every quarter, having this dividend asset into your portfolio can help to subsidize some of the things that you may, have as far as bills and saving is concerned. Now, you do need quite a significant amount of money in order to, be subsidizing your income, but it is possible to do so. A lot of these are dependent on per share value. So let's talk about Realty, which is one of the most popular ones, ticker sign O, which is the Realty Income Corporation. They have a dividend payout ratio of about 24 cents per share. So for each share you have of Realty or Realty Income Corporation, you'll get 24 cents every single month. So 24 cents will be deposited into your portfolio, which is a great way to subsidize your income. Now, I think they're trading for about $60 per share. But as the whole market starts to go down, the prices of stocks start to go down. But that doesn't mean that the price of the dividend goes down. So for all of 2022, they paid out $2.96, which, depending on how many shares you have, can add up, tremendously. And then you can also compound that as well. So let's say you bought one share, and the money you got from the one share, you're just starting to add, and kind of have a snowball effect of increasing the amount of dividend you get every single month based on just holding that share of realty income into your portfolio. Another way you can diversify your portfolio to help mitigate some of the economic pressures of a potential recession is through exchange traded funds, or ETFs. So an exchange traded fund is a type of pooled investment security that operates much like a mutual fund. Typical ETFs will track a particular index, sector, commodity, or other assets. But unlike mutual funds, ETFs can be purchased or sold on the stock exchange the same way that a regular stock can. An ETF can be structured to track anything from the price of individual commodity to a large and diverse collection of securities. ETFs can be structured to track specific investment strategies. The first ETF was the SPDR S&P 500 ETF, or SPY, which is what a lot of people trade currently, which tracks the S&P 500 index and which remains an actively traded ETF to date. So SPY is definitely something that if you got into invest, a lot of people say, oh, I'm going to look at SPY, which is basically just an indicator for the entire market. But there are a lot of people who day trade SPY. There are a lot of options traders who trade SPY. So that's one and the first ETF that was created. There are some other ones that are out there that may be a little more popular. One that you have that's for crypto. There's a crypto ETF called ProShares Bitcoin Strategy ETF, or BTIO, which is the ticker. Is a Bitcoin started strong, gathering momentum over the month of March, becoming one of the most performing assets. The ProShare Bitcoin Strategy ETF is one of the best established funds in the space with about $1 billion in assets. BITO can be bought and sold through the brokerage account, eliminating the need for a cryptocurrency exchange account or a wallet, and is tied to regulated Bitcoin futures that trade here in the US instead of overseas. So basically you can trade Bitcoin without having to get a wallet, and you're just trading the tracking of Bitcoin itself. So you're not really getting into crypto, you're trading it as a stock. So it's kind of a workaround around getting into cryptocurrency itself. Another one for FANG is Microsectors FANG plus ETN, which is ticker sign FNGS. And it consists of Facebook, Amazon, Netflix, Google, and Meta, which are, basically FANG itself, and it just tracks FANG. So if you like all of those stocks individually and you want to have a FANG structured ETF, you can just buy that one. Next is ARK, Next Generation Internet ETF. So ARK Investment is ran by Cathie Woods. She was very popular when she kind of predicted the growth or boom of Tesla, one of the long-term Tesla bulls. I don't think she holds as many shares now as she used to of Tesla, but she was kind of one of the people who talked about the potential of Tesla going up and all the things Tesla was doing when it really had its initial boom, probably like 2 years ago. And so she runs a fund called ARK Investments, and this is one of the funds that she has, which is ARKW. So if you are quite convinced with the buzz around Web3 and blockchain, this ARK Next Gen Internet Fund is a good option. The $1.3 billion fund, ARK Next Generation Internet ETF, is the top performing fund this year, up 40% since January 1st, with a focus on mobile payments. Company Block, it has Roku, it has Zoom, and then also Coin, which is Coinbase. Next, there's another ARK Invest company, or ARK Invest ETF, which is ARK FinTech Innovation ETF, or ARKF, and that one holds Shopify, and it also holds Hood, which is Robinhood, and it is a fund that holds about 800 million. So kind of a smaller fund as far as capital is concerned, but it holds 30 fintech companies, 2 of which are Shopify and Robinhood. Next, there is Global X Robotics and Artificial Intelligence ETF, or BOTZ. So AI has been something that's been trending, significantly. If you believe in the growth globally of robotics and artificial intelligence, then this may be the ETF for you. Ticker sign BOTZ. They have a leader in Intuitive Surgical Incorporated, or ISRG is their ticker. There's Kia Corporation, KYCCF. There's ABB is another company on there, but basically any company surrounded by robotics. This fund is also funded by $1.7 billion currently in their balance sheet. So these are some definitions or just some typical versions of ETFs. There are plenty of ETFs out there for whatever niche sector that you want to invest in, or you could just go broadly like SPY, which is just the S&P 500. Next, I want to talk about commodities. Commodities are another way that you can invest to kind of diversify your balance sheet for a potential recession. You'll be asking, what are commodities? Commodities is a basic good used in commerce that is interchangeable with other goods the same type. Commodities are most often used as inputs in production for other goods or services. A commodity thus usually refers to raw material used to manufacture finished goods, a product, on the other hand, and finished goods sold to consumers. The quality of the given commodity may differ slightly, but it is essentially uniform across producers. When they are tracked in an exchange, commodities must also meet specified minimum standards known as basic grade. So commodities can be traded just like other things in the market. So you can trade gold, you can trade wheat, you can trade oil. These will be things to consider commodities. Each of them have their own individual company, but it's extremely niche down, and it's dependent on that specific commodity. So if you're trading gold, for example, gold may go up as other things start to go down, and it may be a way to counterbalance or counteract your portfolio to kind of make sure that it's diversified, so you still have some positive increase or some positive flow of capital coming into your account. Next, there is buying the dip. So buy the dip just basically means that you're going to buy when the stocks are down. It's another way to say you're purchasing the stock or index after it has fallen. As the stock price dips, it may present an opportunity to pick up shares at a discount and enhance your future gains if and when the stock rebounds to its previous highs. And so it's just basically a strategy of trading, buying things that are on sale. And this is kind of one of the strategies I want to talk about because it's something you can benefit from if you're going into a recession. So during a recession, there are a lot of stocks that are on sale because the whole market is down. So you may be getting things that are on sale, which is the best time to buy them because it's rare that a lot of these go on sale. So you want to get really good names that have good growth potential for the long term, companies that you believe in, companies that you use, and that you understand their business model. So those are things you want to look at when buying the dip, and companies that have longevity. So ultimately, I think those are some great things to do to really counteract or balance your portfolio. Ultimately, I think all of them are dependent on you and your own personal trading journey, how you trade. Some people may day trade a lot of these things. And then some people may, take these different things to try to build a long-term portfolio, a place to just hold cash until the recession blows over. So depending on which way you trade, you may take these different items with a grain of salt, or you may say, okay, I need to enact a new trading strategy to really help grow my portfolio. Like with REITs and ETFs, there may be a way to subsidize your income. But REITs definitely, because there's cash flow that's coming to you, and also other dividend stocks that may pay quarterly, maybe another way for you to counteract some income or get some extra income, saving some cash and putting it into the market, especially getting some of these while they're on sale that still pay out a pretty decent dividend and have a good dividend payout per how much the stock is. So hopefully that information helped you all out. Make sure that you like and subscribe if you're watching this video. Make sure you give it a thumbs up. And whatever streaming service you're on, make sure you drop a comment down below. Tell me what you think about the stream. Tell me what you think about the podcast. Hopefully this information is helping you all. And I'll see you guys on the next time. Peace.